Hey, Dan, bringing another episode of the Mortgage Morsel. And what's been going on? What's the latest? So let's talk about a 50-year mortgage, since I've been seeing a lot of comments from realtors and lenders alike regarding the benefits or lack thereof of a 50-year um, mortgage. And I'm going to just kind of illustrate it here of what the difference is and thoughts of what that might be. I'm going to just use 700,000 Southern California number for a property, 10% down, conventional, using $1,800 for insurance, estimating MI to be a 0.38 factor. So standard 30-year would be, as you see here, 4755. So principal and interest, taxes, insurance, etc. And that would get you on a standard 30-year deal. Now, what if it were a 50? What's that look like? So I'll change that to 50. We're going to have a higher rate. They're never the same. So I'll just assume a 50 half percent higher, puts it 6.25. Payment drops down to 45.12. So that's a savings of about $243 a month. So could that get somebody in? Because the debate, everybody keeps going, oh, you know how much you'll pay if you keep it for 50 years. Newsflash, nobody keeps their, I shouldn't say nobody, rarely do anybody keep their loans for more than 7 years. They've either refied or they've sold and got another property. So there's only a small percentage, I want to say 70 to 80% of people refi or sell. The rest may keep it longer, but I doubt they even go 30 years. Not like, let's say, my parents might have, and so forth, and kind of an old guy here. So everybody's thinking, oh my God, how much are you going to pay in interest if you keep it for 50 years? Not keeping it for 50 years. Okay, the odds are against that. So you have to, my thoughts are, it's get in. It's a way to get in, and then at some point, obviously, you're going to probably refinance into a 30-year somewhere within that 7-year period, or you might even sell and move on for whatever life throws your way. Um, so this thing about 50 years you're going to have forever and the interest you're going to pay, it's very unlikely. So to me, it's more of a short-term play. Get in. Maybe they had a DTI ratio issue at 30 years, but this gets them in. Okay, and then if they have a good lender who's going to consult and keep an eye on it for them, we'll be monitoring it and get back to them about, hey, here's where we're at. How's it look? They've gotten raises and income increases, and then you move on into a 30 or something even lower than that, depending on how long it is. Okay, you've been in for 5 years, let's say. Let's get you into a 25 maybe, or a 27 or something like that. So they're not starting the clock all over again. But so it takes education and consulting with a buyer to see if it actually fits. And again, it could be a DTI issue. We just had a transaction, standard FHA, and you know, long story short is we had Finago. DTI was pushing it because there's some income we couldn't use yet because of a 2-year rule on 1099 income and needing tax returns. Still makes good income, but it was right there on the chalk line. So, we ended up doing 5% down to make it work and pay some debt off. But I mean, again, strategies. So I worked with the strategies to make it work for them. They actually signed loan docs yesterday, the 13th of November. Today's Friday the 14th. So again, it could just be a strategy to get them in, and then hopefully the lender works with them to have it something that they're not going to pay such a huge amount of interest over the long term. To me, it's a short-term play. Get in, build some equity, income increases, whatever the case may be, rates drop, combo of all three, and put them in a different mortgage. So, but yeah, I agree. Who's going to keep it 50 years? Yeah, that's probably not a smart move. It's not the play. Anyhow, that's it. If you have any questions on that, have a different opinion, feel free to leave a message, comment, what have you. And That's it for this episode. Remember, if you're working, I'm working, and I'll see you next time on the Mortgage Morsel.